Every empire claims its money is stable. Every government insists its promises will last. But history proves the opposite. From Rome to France, from the Confederacy to modern Lebanon, people have watched their savings disappear, their salaries lose meaning, and their future stolen by systems they believed were strong. Collapse isn't rare, it's normal. The real question isn't if financial systems fail, but how you protect yourself when they do. The biggest danger is believing that money is permanent. We look at our bank accounts and our national currencies and assume they're solid and unshakable, but money isn't solid at all. It's built on trust, and trust can vanish overnight. That's why history feels so harsh, but also so valuable. Every collapse leaves clues about what keeps wealth safe and what turns to dust. If you look closely, one pattern stands out. The people who survived these disasters weren't the ones who trusted the system the most. They were the ones who questioned it first. They saw the cracks, prepared early, and avoided the trap that caught everyone else. The Byzantine Empire, the eastern half of Rome that lasted nearly 1,000 years longer than the West, built its strength on a single coin, the gold solidus. This coin was so trusted that merchants across Europe, the Middle East, and Asia accepted it without hesitation. For centuries, it was basically the medieval world's global reserve currency. But despite seeing Rome destroy its own silver denarius through debasement, the Byzantines repeated the same mistake, only this time with gold. They slowly reduced the solidus's purity, stretching it with cheaper metals. At first, no one noticed. Then, trust began to break. The coin that once supported Mediterranean trade became just another political illusion. As the solidus lost credibility, the Byzantine economy lost stability. And when the value collapsed, the only people who protected their wealth were the merchants who had quietly held real gold or land outside imperial control. Not paper promises, not government orders. Real assets. And that gives us one of history's oldest lessons. Governments always feel the temptation to weaken their money. And when they finally give in, true value escapes into assets they cannot fake or print. Not every economic collapse comes from rulers messing with money. Sometimes disaster arrives suddenly. In the mid-14th century, Europe faced the Black Death, the worst pandemic in its history. Between 1347 and 1351, up to half of all Europeans died. Cities emptied, villages disappeared, and trade networks broke down almost overnight. But the economic impact wasn't just destruction. With half the workforce gone, labor became extremely valuable. Survivors could demand higher wages, and resources like food and land became plentiful compared to the number of people. Anyone with liquidity, silver, goods, or simply the ability to work found new opportunities. Land that once cost a fortune became cheap. Homes were abandoned. Fields sat empty. The survivors suddenly lived in a buyer's market. We saw something similar during COVID. Supply chains fell apart, governments printed trillions to keep the economy running, and inequality grew. In the United States, housing prices skyrocketed and the stock market bounced back quickly, while millions struggled to pay rent. Those with cash or assets took advantage of the chaos, just like survivors after the Black Death. The pattern is clear. Pandemics redistribute wealth. They always have. After the Black Death, survivors used scarcity to move upward. After COVID, people with liquidity bought property, stocks, and businesses that others could no longer afford. It's a harsh truth, but consistent. Crises reward those with reserves and punish those without them.
Pandemics show how fast an economy can flip. But the banking crash in Renaissance Florence teaches another major truth. Even the biggest institutions can collapse instantly. In the 1340s, Florence was Europe's financial center, led by banking giants like the Bardi and Peruzzi families. They had lent huge sums to kings, especially Edward III of England, who defaulted on massive loans during his wars with France. When Edward stopped paying, the entire system fell apart. The banks collapsed, depositors lost everything, and trade froze. Florence, once wealthy and influential, was thrown into chaos. Ordinary people who trusted these powerful banks learned the hard way that size doesn't equal safety. The lesson is clear. Too big to fail has never been true. Banks and institutions exist to make profit, not to protect your savings. And when they go down, they take your money with them. We've seen this pattern in every era, from Florence's crash to Lehman Brothers in 2008 to banks in Lebanon freezing accounts in 2019. The reality is simple. Institutions are reliable only until the moment they aren't. Understanding that truth is what keeps people safe when the system breaks. The American Civil War is usually remembered for battles and politics, but behind it was a financial disaster most people never learn about. Both the Union and the Confederacy realized that a war this big required printing money. In the North, the government created greenbacks, paper money not backed by gold, only by the promise of the United States. At first, it felt patriotic and practical. But as more greenbacks entered the economy, prices rose and their value dropped. Inflation slowly ate away people's trust. In the South, the situation was far worse. The Confederacy printed graybacks in huge amounts to keep the war going. By the end of the conflict, inflation had exploded into the thousands of percent. A soldier's salary was worthless before he could even use it. Families needed piles of cash just to buy basic food. By 1865, Confederate money wasn't just weak, it was completely worthless. During this collapse, only real assets held their value. Land, food, gold, and anything tangible survived, while paper money became meaningless. Ordinary Southerners saw their lifetime savings disappear, while those with access to hard goods snapped up property at fire sale prices. It's a story Americans rarely hear, but it's important. The United States has already experienced a full currency collapse once, and when it happened, safety came from owning real value, not from trusting the paper in your wallet. France gives us one of the clearest examples of how a revolution can destroy money even faster than a war. In the 1990s, after overthrowing the monarchy and seizing church land, the revolutionaries introduced a new paper currency called the assignat. It was supposed to be backed by confiscated property and stabilize the country. But the government couldn't stop printing more. Each new batch weakened the last. Prices shot up, wages couldn't keep up, and soon the assignat became almost worthless. Farmers refused to trade their food for paper and demanded silver or actual goods instead. In Paris, bread riots returned, and the revolution began collapsing under its own economic chaos. The people who survived this crisis weren't the ones holding patriotic paper money. They were the ones holding food, gold, or property, real assets the government couldn't print. For ordinary Parisians, it was a painful lesson. Even noble promises mean nothing when trust disappears. And when that trust breaks, savings don't slowly fade, they disappear almost instantly.
Jump ahead to 1997, and the same lesson appears in Asia. What started as a speculative attack on the Thai baht exploded into a regional financial crisis. Thailand had borrowed heavily in US dollars, assuming its currency peg would never break. But when the peg collapsed, those dollar debts became impossible to repay almost overnight. Investors panicked and pulled their money out. Currencies across Indonesia, Malaysia, and South Korea fell one after another. Economies shrank, unemployment spiked, and governments rushed to the International Monetary Fund for emergency support. The people who suffered most weren't the hedge funds that triggered the crisis. It was ordinary citizens. Their savings lost value, their mortgages doubled, and many lost their jobs. And once again, the pattern was clear. Those who held dollars or assets abroad survived far better than those who relied on local currency. Countries drowning in foreign debt were forced into painful austerity, while global financial institutions bought Asian assets at bargain prices. What looked like a regional collapse was really a massive transfer of wealth. And the lesson matches everything from Byzantium to Argentina. Debt in someone else's currency is a trap. When the storm hits, it's not the creditor who sinks, it's the debtor. By now, the pattern should be obvious. Whether it's revolutionary France, Civil War America, or modern Asia, the same story repeats. Paper money collapses, debt traps nations and families, and the people who survive aren't the ones who trust the system the most. They're the ones who understand how fragile it really is. The most shocking part is that collapse isn't ancient history. It's happening in modern times. In Lebanon, between 2019 and 2021, banks did something almost unimaginable. They locked their doors. Deposits were frozen, withdrawals were limited. The Lebanese pound lost over 90% of its value. Entire life savings turned into almost nothing. Middle-class families, retirees, doctors, engineers, anyone who trusted the banking system saw their money disappear. The lesson was harsh. Your bank account isn't a protected treasure. It's a loan you give to a bank, and in a crisis, that bank can simply refuse to give it back. The people who survived were the ones who had diversified abroad, held real assets like gold or property, or kept cash outside the system. Everyone else was stuck. And this isn't far away. In 2008, Americans watched homes get repossessed and pensions collapse, while the banks that caused the crisis were rescued. In 2020, governments printed trillions during the pandemic, pushing asset prices higher for the wealthy while wages barely moved. In 2023, several regional U.S. banks collapsed almost overnight when depositors panicked, proving again that too big to fail is just a comforting myth. The warning is simple. Systems break. And when they do, only those who prepare ahead of time stay standing.
So how do you protect yourself when everything starts breaking down? History shows there isn't one perfect strategy. In Byzantium, people relied on gold. After the Black Death, the survivors who had liquidity could buy abandoned land. In Florence, the smart move was not trusting too-big-to-fail banks. In the Confederacy, hard goods held their value. In France, food and property became the real currency. In parts of Asia, avoiding debt in someone else's currency was the shield. And in Lebanon, the safest people were the ones who got their money out before the banks closed. The details change, but the theme stays the same. Survival comes from understanding what holds real value when systems and promises collapse. Here's the surprising part. Collapse is both disaster and opportunity. For the unprepared, it destroys everything. But for those with resilience, liquidity, or assets that can't be printed out of thin air, it becomes a moment to buy what others are forced to sell. After the Black Death, peasants became landowners because there was too much land and too few people. After 2008, those with cash bought homes while millions were foreclosed on. History makes one point over and over. Protection isn't only about avoiding losses, it's also about being in position to capture opportunities when others can't. But wealth isn't just about what you own, it's also about what you can do. The people who survived history's worst collapses weren't only the ones with gold or land, they were the ones who could still create value when everything else fell apart. The baker who could make bread, the craftsman who could repair tools, the farmer who could feed a village, the merchant who could move goods across borders. These people didn't only survive, they advanced during the crisis. In every collapse, money can lose almost all meaning, but production never does. People will always need food, repair, shelter, and trade. And those who can provide those essentials rarely stay poor for long. That's the deeper form of protection, not trust in institutions, not waiting for governments or banks, but a mix of real assets, real skills, and the awareness that financial illusions eventually break. Every crisis is a transfer. Value moves from the many who trusted the system to the few who prepared for its failure. It shifts from paper promises to real, tangible assets, from passive savers to people who know how to build and act. History repeats this pattern over and over. So the real question isn't if things fall apart. They always do. The real question is whether you'll be left holding empty promises or holding something real. History may not repeat exactly, but if you ignore its warnings, it will hit you just as hard. Don't miss what history is trying to teach us. Hit subscribe before it's too late.